bull put spreads. A bull put spread is made up of only put options. You buy a put with one strike price and write or sell another put with the same underlying stock and expiration month, but at a higher strike price. This position is a credit spread because you'll always receive more cash for the short put than you pay for the long put. You'll always receive a net credit when you establish it. Here's an example. Buy one XYZ June 60 put, $4. Sell one XYZ June 65 put at $7. We would like to thank you for taking the time to watch the videos that we have put together for you today. Take a look and subscribe to our YouTube channel, our Instagram, our Facebook page, and reach out if you have additional questions. We would love to hear from you. Check out our website for more information. Go to www.optiontradersnetwork.com. Thanks so much.